Welcome, friends, to yet another session of NMBF Coffee Chats. This Thursday afternoon, 12 o'clock, is a time when we meet for our senior friends, whom we lovingly call Golden Jewels, because they are so precious in the eyes of God and for all of us. We are a church-based social media channel. Our Lord Jesus Christ has taught us to serve people, and so that's what we do. And we love serving people, no matter what religious, cultural background they come from. Yeah, so we are so happy that you have joined. If any of you has joined here for the first time, we would really love to get in touch with you and be your friends and help you out in any way possible, whatever issues you're facing, by holding such awareness lectures. Yeah. Okay, so I want to welcome brother speaker today, but I'll give the honor to brother Murli, who will be introducing our speaker and also be moderating today's meeting. Brother Murli himself is a banker with a lot of financial knowledge, and we are very happy that we have such a wonderful person because of whom this meeting is possible. Sarvanan sir has helped us earlier also in a session on financial planning for seniors. So please do see that video on our YouTube channel, NMBF Coffee Chats. Over to Brother Murli.
Thank you very much, Pastor Abhijit. It is indeed a pleasure to reconnect back in this manner with by having Mr. Saravanan on the call at this afternoon time. But before I proceed ahead, I just want to tell, although I have been a banker for nearly 36 plus years in State Bank of India and for another 3 plus years in another training college as a principal of a training college, I must confess and tell you that similar to what condition I am in, Mr. Saravanan, 3 years ago, I think it's important for me to say this before we start and hand over the mic to Mr. Saravanan. I was talking to one of my friend in the church, and he was saying, "Hey, what are you doing about your income? I think you are struggling with your income tax returns and things like that." They said, "Are State Bank? I invested all my retirement funds in State Bank, and that's not giving me much of a return with all the tax implications and so on and so forth." Then he said, "I have a friend, Mr. Saravanan, and who is a certified financial planner for the benefit of all of us here. He's a certified trust and estate planner. He's also a certified mutual fund planner and certified retirement advisor. Everything connected with money, finances, and our planning of for our existing life now and also for later before we are much gone from this world." So I connected with him, and he said, let's have a video call." And in that video call, he connected my wife and I. He asked, what are our aspirations in life? Where do you want to go, and how do you want to spend your later life, and all of that? That sounded so very beautiful, emphatic. His touch, his calling that was there on the video call that he made was really intimate. I said, there is a father in this person who is handholding us, and he didn't charge anything to me at that time. Even now, he does not has not charged me. Okay, the point here I want to make is that he took over a little of my portfolio, and today I am much benefited as compared to what this money would be simply lying in State Bank of India, earning a petty sum of just 2% of interest after knocking off all the taxes and all of that, right? So this is a little background. So I am myself, I'm a testimony, and I'm glad that Pastor Abhijit has invited me and given me this opportunity to moderate this program. And this is a testimony I want to give about Mr. Saravanan and his little company called Purple Pond, right? So this is a little bit thought about it. And before I hand over the mic to Mr. Saravanan, I also want to share for the benefit of all the viewers here. We did a program recently, and that is on the YouTube, as Pastor Abhijit was saying. I would encourage you to please see that. And our association together as a financial advisor and as a banker, we did a program for the palliative care for a Pallium India, where we did about nearly 45 minutes, 1.5 hour session with question and answers. And that was also a very big eye opener, is what people have responded with. Okay. With this background, I just want to lay these questions for the benefit of all of us on behalf of all of the participants here. These are the questions that are there before me, Mr. Saravanan. And I think in your presentation, in your talk, you'll cover the answers concerning all of these questions. The following are the questions. Number one is, I'm a senior citizen, and what is the specific tax benefit available to me as a senior? Number one. Second one would be, how do I minimize my tax liability? Being a senior citizen, right? The other third question could be, I would encourage people around here in the call, please take down a piece of paper and write it down, because our memory is too small, a little, and sometimes we tend to forget whatever is being discussed. Otherwise, what you don't write in paper becomes a vapor, and then ultimately, yeah, he was saying something, but I've not jotted down, things like that. So I would encourage you to scribble something in your paper. Another question could be, what should I know about the old regime and the new regime that in the recent budgets that were presented? Please tell us about that. And now, since I'm getting old, the medical expenses are major area where I'm concerned with. And if I incur money in my medical expenses, irrespective whether I have an insurance or not, what are the benefits that are there, and how does the medical expenses impact my annual tax returns? This is a question that we have. And a couple of other questions could be, can I gift money to my family members, to my son, my mother, father, or something? And what are the tax implications for all of that, right? And just a couple of more questions. How do I handle my retirement income from various sources? It could be rental income, it could be fixed deposit incomes, it could be income from mutual fund. How do I handle my retirement income so that I pay less to the government and earn from all of whatever I get as a bonus, right? And are there any specific investments where I could get a higher benefit? Like in my own case, where I was saying that you encouraged me to withdraw money from the bank fixed deposit and invest this in a mutual fund, and that benefited me a lot. Today, I see happily that my investment is growing much better and with less taxes to be paid to the government, right? So with these are the questions I believe you will definitely cover in your presentation. Thank you very much. And I leave the floor open to you. And I request all of the participants here on the call, if you have any questions, please post it on the chat, and I will take them based on a time available at that moment in time. And Mr. Sarvanan will speak to us nearly for 40 minutes now. Already 30 minutes has gone now, 40 minutes. And thereafter, we'll have a Q&A session for about 14 or 15 minutes, and then we'll wind up the session, right? Thank you very much for accepting our request, Mr. Saravanan. Thank you very much, Mr. Abhijit, for organizing this program, and wish you all the very best, and God bless you. Over to you, sir.
Yeah. Yeah. Entire screen. Okay. Just a moment.
Not an issue. Please go ahead, sir.
Yeah, I'm just. Hope the screen is clear and visible.
Yes, it is.
Good afternoon, everyone. At the outset, thank you, Mr. Abhijit and Mr. Murali for a wonderful introduction. Okay, today, before beginning the session, I'll make a disclaimer. I'm not a chartered accountant. I'm a certified financial planner. The views expressed here are out of practice of tax planning to all our clients. So while implementing some of the discussions that we make, please do consult your own auditor, before confirming your decisions. With this, I'll just get into the tax planning aspects for senior citizens. since the title was tax planning for senior citizens, probably I have confined my presentation to people of age above 60. But I also see people, young and energetic people, joining the presentation. Please pardon me if the presentation is little irrelevant to you, or you can help your uncles and aunties who are above 60, and you can be instrumental in carrying this message to them, and they can do their tax planning with this inputs. With this, we'll just get into the... See, the moment somebody talks about tax is something which is very uncomfortable word. The word which gives immediate uncomfortableness is probably Oxford Dictionary can also put tax as a synonym to uncomfortable feeling. That is how we have always been feeling about taxes. But if you look at the tax is just part of your earning. It is your earning which you are going to give it to the government. Why should someone pay to government? Because government is a welfare state, and without your taxes, government will not be able to dole out the welfare schemes. And God has created everyone, but God has not created everyone with equal capability to earn money. There are people who will not be able to, who are not blessed with the ability to earn money. There are people who are abundantly blessed to earn money. So it is on the right attitude basis that if we have the abundant attitude, abundant capability to earn money, we do share some tax to the government so that the other people who have not been bestowed with that kind of capability are also taken care of. So with this, let's get on to what are the taxes. When you say taxes, you have two types of taxes. One is called direct tax. The other is called indirect taxes. So what are the direct and indirect taxes? When you say income tax, it's a direct tax, corporate tax, and securities transaction tax. People who are already dealing with mutual funds or dealing with stock transactions, they must be aware of what a security transaction tax is. The indirect taxes are taxes that you pay for your services. GST is a form of an indirect tax. If you import anything from abroad, import duty, custom duty is an indirect tax. And whatever we pay to the SRO, sub-register office, while buying a property, that is the stamp duty. That's also an indirect way of collecting taxes from the common public. These are the broad classification of taxes: direct taxes and indirect taxes. Let us look at what are the sources of income. See, we have different source of income, but Income Tax Act classifies the income source as income from salaries, income from house property, income from business or profession, income from capital gains, and if the income does not fall in any of the four category, government is very wise putting it as other income. So whatever has not got a place in the above four category will find a place in other income. We'll see how this other income is being taxed also. So if you look at it, if you look at it, salaries. See, what are the definition of salaries? When you are above 60, probably you can always say, I don't get salary. But the term salary means it can be an active salary, or it can be a pension from your employer, or pension from any of the annuity plans that you have taken. It can be a superannuation plan, or it can be a insurance-based annuity payments. All these things are clubbed under one definition called salaries. So I don't earn salary. If that is the posture that you're making, no, your pension is also treated as salary by the income tax department. Then coming to the house property, most of us derive income from rental. So rent from a residential house property, rent from a commercial property let out. So this is a rental income that you derive. I'm just restricting it to rental income. I'm not talking about the loss from house property. For the benefit of people who are below 60, if you have housing loan and if you pay interest to the housing loan, that can be deducted from your income in the form of a loss from your house property, where you are self-occupied for that particular house. If you are paying a loan, that interest to a maximum of 2 lakhs can be deducted. That will be termed as loss from house property. For senior citizens, I assume you will not be still continuing with your housing loan. So for I have brought in only rent as the income from house property. Then comes business or profession. So when you have business or profession, probably you may be using your wisdom, your experience, and doling out consultancy to people who are currently doing business. So from that, if you are earning, then it is taxed under the head business or profession. Then comes the fourth one, the capital gains. This is a very important aspect. Capital gains are one of the easiest way or one of the optimal way to reduce your taxation. Mr. Murali was saying, what are the ways we can reduce taxation for senior citizens? We will deal with that. Capital gains is one form of taxation where it can be lower compared to your marginal rate of taxation. This we call it as special rate of taxation. If your income does not get defined in any of this, by now you would have been wondering, I get income from post office, I get income from my bank, I don't see anything here. Yes, all those interest income are clubbed under other income. So whatever dividend you get from your investments or whatever interest income you generate, either from a savings account, from a FD, from your bonds, RBI bonds, whichever doles out a interest income. It could be an FD or post office product, senior citizen savings scheme, whatever product, whatever is the output called interest income, that will be taxed under the head other income. So these are the broad income sources, and these are the few areas where you generate income under each heading. Now we are getting into this old regime, new regime. See, government wanted to actually simplify the tax structure and help the resident individuals, to be so friendly with the taxation. I don't know if the objective has been met, but now we have two choices. One called old regime, the second called the new regime. The old regime, here I am dealing with people of age 60 to 80 and people of age above 80, senior citizens and super senior citizens. So if you have the standard deduction, pardon me, just the standard deduction, you don't have to produce any proof for this. You can deduct 50,000 straight away from the income that you earn in the year. So that's called a standard deduction. After deducting the standard deduction, you will have to go through a slab-wise taxation. Don't worry about the slabs. We will do a example, or we will bring out a real case scenario and try to tell you which one will be beneficial for a senior citizen. So this is the slabs. If you are 60 to 80, you don't have to pay any taxation up to 3 lakhs. And if you have income up to 5 lakhs, you will pay 3 to 5 lakhs 5%, 5 to 10 lakhs 20%, and above 10 lakhs, you will pay 30%. If you are above 80, 0 to 5, you don't pay any tax. 5 to 10 will be 20%, and above 10 lakhs, it will be 30%. Now coming to the new regime. In the new regime, in this particular budget for the financial year 24-25, the standard deduction has been increased from 50 to 75,000 only for the new regime. The old regime, it was left untouched. It is at 50. So regarding the tax slab rates, they have rationalized or they have broadened the tax slab, but they have taken away the distinction of individuals below 60, 60 to 80, and above 80. This particular new tax regime has become age neutral, gender neutral. So already the income tax department has become gender neutral. Earlier we had some relaxation for females, but that has been done away with during the past 4 years or something. Now, in this new tax regime, the new tax regime is now gender neutral and age neutral. So if you look at it, you have a broadened tax slabs. It starts with 0 to 3 and ends above 15 lakhs. So with this broadening of tax slabs, the tax burden on the individuals are much lesser. So we'll just get this through an example that I'm going to show you. So sample we have calculated, we are assuming somebody is earning 10 lakhs for the financial year 24-25 and he has a standard deduction of 50,000. So as you calculate his taxation as per the tax slab, he will have to pay a 1 lakh taxation. The taxation computation works like you deduct 50,000 and you have 9.5 lakhs. If you put this 9.5 lakhs through the slab rates, then you have to pay 1 lakh as the tax during this financial year. So a senior citizen who is between 60 and 80 is the example we have taken. So he is faced with, if it is an old regime, he is faced with paying a tax of 1 lakh. Do we have an alternative to this? Yes. Now we look at how the same income would be taxed through a new scheme. The new scheme, first, the standard deduction is 75,000 rupees. So you have a taxable income of 9.25 lakhs. When you put this 9.25 lakhs through the broadened slabs, you end up paying 42.5 thousand or 42,500 rupees. So if we straight away compare these two calculations, I've just listed here both for your consumption, like the earning is same 10 lakhs. And if you calculate it through a old tax regime, you are liable to pay 1 lakh as the tax. And if you adapt the new tax regime, you are liability to pay 42,500. This is an oversimplified calculation just for an understanding. The old tax regime has some of the benefits in terms of deductions, which the new tax regime will not offer you. So people who already have certain deductions, which you have been doing it, say for example, you have been paying health insurance premium, you have been paying to NPS, all these deductions will be allowed in your old tax regime, which are not to be entertained in the new tax regime. So it is the new tax regime or old tax regime, the question is going to be entirely personal. The personal finance has become very, very personal. You can't make a sweeping statement that the new tax regime is advantageous. For each and every one of the individual, we need to go through this calculation before we declare which regime is going to be beneficial. And the default regime, if you don't do this exercise, the default regime is new tax regime. So it is each one of us, the onus is on us to go through both the tax calculations, both the tax computations to arrive at which is favorable for us. And the income tax department and the government of India has given you this relaxation or this benefit of deciding whichever tax regime is favorable to you, that can be adapted for the particular financial year. See, probably last year you would have filed through a old tax regime. Now you have completed, you don't have major deductions. You want to get through the new tax regime, you can adapt new tax regime this year. So every year you can put your income through this tax calculators, or you can approach people like us. We will run this tax calculator for you, understanding your deductions, if any, and then we will come back and tell you, we will calculate and tell you which tax regime is favorable to you. Please take some time, go through this computation before deciding, I'll file my tax whether through old or new. Normally, we need to run through this to find out which is advantageous to a particular person. I think the example is self-explanatory. In this case, the new regime saves about 67,500 rupees for the senior citizen. I think there is a computational mistake. It is 57,000 rupees 500, 57,500 as the tax saving by moving from a old tax regime to a new tax regime. Okay. So having said this, now we will dwell some time on the question which Mr. Murali has asked. Is there any way I can optimize or reduce my taxation? So whatever instruments that you are using, like senior citizen savings scheme, bank FD, or time deposit from post office, all these instruments will give you the interest income. Interest income are to be taxed as per the slab rate. So we will now try to find out, we will try to have a senior citizen going through is retirement cash flow planning. So the next slide, which talks about a fixed income cash flow planning. So somebody has got a crore of rupees as his retirement proceeds, or he has targeted 1 crore and he has accumulated 1 crore for his post-retirement cash flow. This is the situation. So take it as he has approached me for planning the investments. And definitely we would not rush to plan like this. We will have a detailed discussion. Let's assume the planning has been done and we have given 3 different fixed income products. The RBI bond at 8.0, the post office at 8.2% annualized, and the PNB housing FD at 7.8%. So when you convert all this into a monthly equivalent, because RBI bonds give out interest once in 6 months, the post office senior citizen savings scheme, they give out once in a quarter. PNB, you can definitely take it monthly. But if you equate everything to a monthly, it works out to be 66,808 rupees. This is where a planning can help. So suppose if you and your spouse, a senior citizen and a spouse, they are living out of this cash flow, and their requirement for daily living is 45,000 rupees. They have a house of their own and their requirement is 45,000 rupees, including their medical expenses, including their regular tablets and regular travel or whatever. 45,000 rupees, if they are able to contain their living expenses, in this case, look at it, 21,000 rupees they are generating a excess income. If you could have planned or you could have little worked out your living expenses, and if you knew 45,000 is going to be my living expenses, then the planning could have been little different. How it could be different? The interest income what you get, whether you consume it or you go for a cumulative option also, the interest income is to be taxed on every year end. It goes for a taxation as on 31st, you will have to compute your tax and pay the tax during the tax filing season, July 31st, on or before July 31st. How this could be differently done? See, an amount equivalent to 45,000 rupees, roughly if you look at it, around 60 lakhs could have been invested into these three instruments, doling out 45,000 rupees per month, and the balance 40 lakhs could have been invested into an instrument which can give you capital gains. The beauty of capital gains, that is, if you invest into a mutual fund, the returns generated by mutual fund are not to be taxed on every financial year end. Those are going to be taxed only when you withdraw. Say, if you don't withdraw, you are not going to pay tax. The same, even if you take a similar return 8% from a mutual fund, same 40 lakhs giving you 3.2 lakhs per annum, this 3.2 lakhs will never ever be taxed unless you are going to withdraw some amount. Even when you are going to withdraw some amount from your mutual fund parking, that also will be considered as withdrawal of your capital and capital gain, and the tax that you will be paying is very, very less compared to the entire interest being taxed. So this is one area I want to emphasize today in this particular presentation. Please consult your auditor or the advisor with whom you are having your personal finance being dealt. Generate only the income that you would require. When I say you would require, I'm not trying to be very, very particular about nearer to 1 rupee, but have the buffer and generate income which is required for your living expenses. I know people who are generating 1.2 lakhs per month, where their expense is only 50,000-60,000 rupees. So half of the amount is generated, and because it is generated as an interest income, they do pay a lot of tax at the end of the year. So first point of reducing your taxes or planning your tax liability starts in planning to generate income from your corpus that you have accumulated. So for all the senior citizens, my only appeal is please plan before you invest. Don't keep on adding to the interest income and start paying a lot of taxes during a post-retirement period. So the next important aspect, a question which will come into anyone's mind is, Are Baba, this man is trying to ask us invest in stock market, which is very risky, senior citizen. I don't have an income. All that is fine, sir. We heard all your concerns. Yes, the mutual funds, when spelled out, it is not directly referring to equity mutual funds. Mutual funds do have debt mutual funds, which are completely disconnected, completely away from the market up and down movements. So you can even invest your money into corporate bond funds, which are AAA rated, where the risk is almost nil. So you can park your money there. It will earn 8%, but it will not tax you every year. Or if you have the little bit of long-termish view on your investment, you can invest into some products, hybrid products, where there is a small dose of equity, 20%, 30% equity, where you are likely to get 8 to 10% with very minimal. And if you stay invested for more than 3 years, our experience shows that people have not lost even single rupee on the investment. So please spend some time, discuss with your investment advisor or auditor, and only generate interest income, which is almost meeting your living expenses. Don't generate extra income, and that would result in paying extra tax. The next, we will get out to the benefits senior citizen can avail if you are using this big if. Please remember, if you are using old regime, these benefits are applicable. So you have sections called ATC, ATCCC. These are all sections, we call it under the chapter 6. So chapter 6 gives you certain tax benefits. You can invest up to 1.5 lakhs in any of the specified instruments, like mutual fund do have 1.5 lakh tax planning investment called equity saving scheme, or you can put it in a 5-year bank fixed deposit that also qualifies for the ATC deduction. So then you have, if you want to plan your taxes and you want to take another 50,000 rupees from NPS, now NPS gives you a provision to have your investments done till the age of 70, and you can invest till the age of 70, and you can complete your investments. I mean, you can withdraw everything at the age of 75. So the entry age has been broadened for NPS also. So you can use NPS ATCCD1B. That gives you another 50,000 rupees. During the financial year, if you invest 1.5 lakhs, yes, that you can deduct it from your taxable income. If you invest 50,000 rupees into NPS, that also you can deduct it from your investment. So there is another section called ATD. This is a popular section. Most of you would be using it. This ATD is a section which deals with health insurance benefits. If you're paying a premium, 50,000 rupees per year, you can claim a deduction. And if you're financially dependent on your son or daughter, they also can take a policy in your name. They can be the proposer and they can claim this 50,000 rupees. Suppose if you are taking it on your own for you and your spouse, you can claim this ATD in your tax filing. During tax filing, you can. Okay, next, I am a super senior citizen, or I have missed taking the insurance policy during my early 60s. Now I am not eligible, or people are not giving me the medical insurance. Then also government tells you, like, up to 50,000 rupees, you can have the deduction showing it as a expense that you have made towards treating yourself, or it's a medical expense which you have spent during the financial year. Even without a health insurance, you can claim this 50,000 rupees. Coming to the next section, which is called ATDDD, ATDD. ATDD is the payment that you would be making towards maintaining a handicapped dependent, disabled dependent. So disabled dependent, there is a guide available with the medical fraternity where they will be able to gauge the disability, and they'll be able to give you whether the disability is 40%, whether the disability is 80%, if the disability is irreversible, if the disability is non-irreversible. All these medical definitions will be there, and you need to obtain a certificate from the competent authority. With that certificate, you will be able to take a tax deduction of 75,000 rupees if the disability is below 80%, and if the disability is above 80%, and if it is termed as permanent, you can claim 1.25 lakhs. If the disability is severe, that is more than 80%, then you can claim 1.25 lakhs as deduction under this section. Then comes the next section is called ATDDB. You talked about expenses towards dependence. This ATDD talks about dependence, and ATDDB talks about the individual, the person who is an earner who is getting treated for some specified diseases. These specified diseases have been listed in 11DD form of the income tax department. And if you are suffering from any of this listed diseases, then you have a deduction of up to 1 lakh for treating these specified diseases. The specified diseases can be Parkinson's, it can be dementia, or it can be neurological diseases. Once these 80D is understood, now we will move on to 80TTB. Boss, I am deriving my income only from my deposits and post office schemes. I don't have any other income. Then you have a 50,000. If you are above 60, you can claim a 50,000 of the interest income as your deduction. This is applicable for your savings interest, for FD, and any deposit that you have with post office. Bank FDs, post office FDs, post office senior citizen scheme, interest income up to 50,000 can be deducted from your income. That is under section TTB. Now, I have my generosity, or I am a person who loves to donate. Do I have something which I can claim if I donate? Yes. You can, under section 80G, you can donate and claim tax deduction. There are 4 different possibilities, and the details, I thought it will be too much during this session. So you can write to me, or you can, through Murali,
Yeah,
you can
that will be
contact
good.
us.
I
Yeah,
think
you
these numbers, DDD and G and F and all of that is going above our head
are going
sometimes.
above the
So
head. Okay.
I think,
Okay, so this is daily routine for us, sir. So I don't have a problem, but I'm sure
yeah,
if it is heard the first time, yes, confusing. So when you are, one thing you can remember is, if you are donating for charity, you have the possibility of detecting that as your tax deduction under section 80G. So details you can.
yeah,
So one more instrument which I wanted to discuss here is reverse mortgage. So we all live in a self-occupied property. If you would like to use the self-occupied property, if you are little bit constrained on your cash flow, and you want some source from which you can derive your income, this can be a beautiful instrument, a reverse mortgage. What is reverse mortgage? You can just draw a parallel to the way you borrowed it from the bank and you bought a property to live in. Now you have the property, the title is in your name. Now you can ask the bank to fund your living, and after your life, bank can take charge of the property. This is called the reverse mortgage. Now in India, in US, it is very famous. In European countries, it is very famous. In India, it is catching up. And you can use this tool, you can use this product and meet your post-retirement cash flow if you want it. So what are the characteristics? Senior citizen, you need to be a senior citizen. Then the age has to be either of the spouse should be more than 60. Then the property should have a residual life of 20 years. Probably you will not be able to use a property which is already old and it does not have a residual life. This residual life will be certified by a engineer, chartered engineer. Certification, you can go for this reverse mortgage facility. And if you look at it, the borrower should not be having outstanding on that particular property, because you are not the title owner. If you have any outstanding, bank also has an encumbrance on your property, so you will not be allowed to use that property for reverse mortgage. So satisfying these 3 conditions, you can use your property to enhance your post-retirement cash flow. The very important aspect of bringing this particular product is the entire amount that you receive is tax-free in your hands. So this is one product which is specifically tailored to the senior citizens. If you put your house under reverse mortgage and if you're able to generate a cash flow, the entire cash flow becomes tax-free in the hands of the senior citizen. This is one point which I wanted to emphasize on. Then this, I think I've covered earlier also. There are 3 ways of looking at the tax. You can plan taxes. These are all legitimate way of planning taxes, which we talked about the different sections. So you can become a tax planner. You can plan your taxes and reduce your taxes. The other option is to avoid tax. Avoid tax, you can use some of the loopholes or some of the interpretation in tax law, and you can decrease your tax. That is also not looked at very differently. You can even try avoid tax with certain intricate details using your auditor's brilliance. These 2 are fine, but the third point is something which you should never attempt doing it. Tax evasion. Tax evasion is a punishable offense. So please don't get into not showing your income, keeping your income away from the tax radar. All these things amount to tax evasion. Tax evasion is a criminal offense and it can lead to severe penalty and jail term also. With this, I conclude my session. Thank you so much for patiently listening. Yes, sir, I am open for the questions.
Timed very well. Timed very well. Very well done. I mean, the last statement that you just said, Jesus himself said, give to Caesar what belongs to Caesar. When tax was to be, they asked a
Correct.
question to Jesus, should we give to Caesar the tax that is due? He said, yes, what belongs to Caesar should be given to Caesar. Very beautifully concluded. Tax evasion versus tax avoidance. Tax evasion is immoral, illegal, and will all end up into courts and jails. Tax avoidance is planning